Retire on dividends. That's Warren Buffett's strategy for living off his investments without ever touching his principal. While most retirees worry about market crashes and outliving their savings, Buffett collects millions in dividend income every year, no matter what happens to stock prices. The best part? This method isn't reserved for billionaires. It can work for you too, but most retirees never take advantage of it. Why? Because they don't understand how to retire on dividends the right way. Let's break it down step by step. If you want to learn more about retirement planning, click the subscribe button right below the video now. The power of dividend investing. Most retirees rely on savings and Social Security to fund their retirement. But what happens when those savings start to run low? Warren Buffett avoids this problem entirely by living off dividends instead of selling his investments. Dividend investing is powerful because it provides a steady income stream without depleting your principal. If you own the right dividend-paying stocks, you can collect cash payments regularly while your investments continue to grow. This is why Buffett prefers owning businesses with consistent and increasing dividend payouts. Take Coca-Cola, for example. Buffett invested in the company decades ago, and today it pays him over $700 million per year in dividends without him having to sell a single share. That's the beauty of this strategy. It creates a passive income stream that can last a lifetime, but not all dividend stocks are created equal. Many retirees make the mistake of chasing high yields without considering the stability of the company. Buffett, on the other hand, focuses on businesses with a history of reliable dividend payments and consistent growth. These companies continue paying dividends even during recessions, ensuring that his income never stops. Imagine having a portfolio that generates thousands of dollars in passive income each month, covering your expenses while your investments keep growing. This is exactly what Buffett's strategy allows, and it's something any retiree can achieve with the right approach. So how does Buffett pick these dividend-paying companies? That's where his stock selection strategy comes in. How Buffett chooses dividend stocks. Not all dividend stocks are worth investing in. Many companies pay high dividends today but struggle to maintain them in the long run. That's why Buffett follows a strict selection process, focusing on businesses that generate consistent, growing dividend income for decades. His secret? He invests in companies with a moat, a competitive advantage that protects them from competitors. These businesses dominate their industries, have strong cash flows, and can consistently increase dividends year after year. Take Procter & Gamble, for example. The company has raised its dividend for over 65 consecutive years. Buffett knows that consumer staples like toothpaste, soap, and household products are always in demand, making this a reliable source of income. Here's what Buffett looks for when choosing dividend stocks. Dividend growth history. A company that has consistently raised dividends for at least 10 to 20 years. Low payout ratio. Companies that pay out less than 60% of earnings as dividends have room to grow. Strong balance sheet. Low debt and consistent profitability ensure dividends can keep coming. Recession-proof. Business model. Even in economic downturns, the company keeps making money. Buffett doesn't just chase high yields. He prioritizes sustainable growth. A stock with a 2.5% yield that increases dividends by 7% annually can outperform a high-yield stock that never grows. By selecting businesses with strong fundamentals and growing dividends, Buffett ensures that his retirement income isn't just stable, it increases over time. And this is the key difference between just investing in dividends and truly retiring on dividends. But how much does dividend growth actually matter? That's what we'll cover next. Why dividend growth matters more than yield. A common mistake retirees make is chasing high dividend yields. A stock paying 7% or 8% might look attractive, but what happens if the company cuts its dividend? Warren Buffett avoids this trap by focusing on dividend growth, not just yield. Here's why it matters. Let's say you invest in a stock with a 3% yield, but it grows its dividend by 8% per year. In less than 10 years, your dividend income could double, providing you with more cash flow without investing another dollar. Meanwhile, a stock with a 7% yield but no growth will give you the same payout year after year, with no protection against inflation. Buffett understands that long-term income growth is far more powerful than a high initial yield. He invests in companies like Coca-Cola, which has increased its dividend for over 60 consecutive years. When he first bought Coca-Cola shares in the 1980s, the dividend yield was low, but today he earns over 50% annually on his original investment just from dividends. How can you apply this to your own portfolio? Look for stocks with a moderate yield, 2.5% to 4%. A strong history of dividend increases growing earnings, so they can afford to raise dividends. A payout ratio below 60%, ensuring sustainability. This strategy helps retirees build a rising income stream that keeps up with inflation, ensuring they never run out of money. Now, imagine if you reinvested those growing dividends before retirement. That's how Buffett turned his investments into a dividend snowball, which we'll cover next. The snowball effect, reinvesting dividends before retirement. Warren Buffett often says, the biggest mistake people make is they don't learn to harness the power of compounding. This is exactly why he reinvests dividends for as long as possible, allowing his wealth to grow exponentially before tapping into it for income. This strategy, often called the dividend snowball, works because of compounding. Here's how it plays out. You invest in dividend-growing stocks. These stocks pay you dividends regularly. Instead of spending the dividends, you reinvest them to buy more shares. Over time, your share count increases, which means you earn even more dividends. This cycle repeats, accelerating your wealth growth without adding extra money. Buffett's stake in Coca-Cola is a perfect example. He reinvested dividends for decades, turning a small initial investment into a $25 billion holding. The dividends from these shares now pay him over $700 million per year, all without him having to sell a single share. Why this strategy works for retirees? Your income grows automatically. Instead of relying on savings, your dividends increase year after year. It protects against inflation. If your dividend income rises by 7 to 10% annually, you maintain your purchasing power. It reduces risk. You don't need to time the market or worry about stock prices. Your focus is on cash flow. The best time to start reinvesting dividends is as early as possible. But even if you're close to retirement, compounding for just a few extra years can make a big difference. So, when do you stop reinvesting and start living off dividends? That's what we'll cover next. When to start living off dividends. At some point, you stop reinvesting dividends and start using them to cover your living expenses. But when is the right time to make that switch? Warren Buffett's strategy offers a simple answer. Live off dividends only when your portfolio generates enough income to sustain your lifestyle without selling shares. For most retirees, this means shifting from growth mode, reinvesting dividends, to income mode, collecting dividends, when they retire or semi-retire. But to make this transition smoothly, you need to ensure your portfolio is set up correctly. How much do you need to retire on dividends? The amount depends on 3 factors: your annual expenses, how much income do you need to cover your lifestyle, your portfolio's dividend yield. A 4% dividend yield on a $1 million portfolio generates $40,000 per year in passive income. Dividend growth rate. If dividends grow at 6 to 8% per year, your income will increase over time, protecting against inflation. Many financial experts suggest the 4% rule, which means withdrawing 4% of your portfolio annually. But with a well-structured dividend portfolio, you could live entirely off dividends alone, never touching the principal. This is Buffett's approach. He collects dividends while his investments continue growing. Transitioning to dividend income. Step 1. Reinvest dividends for as long as possible to maximize compounding. Step 2. Gradually shift to collecting dividends as you approach retirement. Step 3. Ensure you have a mix of dividend stocks that provide stable income. Step 4. Factor in taxes. Dividends are taxed differently based on your income level. By following these steps, you create a self-sustaining income stream, just like Buffett. But how do you build the right dividend portfolio from the start? That's what we'll cover next. How to build your own dividend retirement plan. Now that you understand Buffett's approach, how can you apply it to your own retirement? Building a portfolio that allows you to retire on dividends requires careful selection of stocks, smart reinvestment strategies, and proper risk management. Here's how to do it, step by step. Step 1. Choose the right dividend stocks. Not all dividend-paying companies are good long-term investments. Buffett focuses on businesses with consistent dividend growth. Look for companies that have increased dividends for 10-plus years. Strong financials, low debt, stable revenue, and strong cash flow are key. A reasonable payout ratio, ideally below 60%, meaning the company isn't overextending itself. A competitive advantage, companies with a moat like Coca-Cola or Johnson & Johnson tend to survive recessions. Step 2. Diversify your holdings. No single stock is 100% safe. Buffett diversifies by investing in different sectors that generate steady cash flow. A strong dividend portfolio should include consumer staples, companies like Procter & Gamble, PG, and Coca-Cola, KO, that thrive in all economies. Healthcare, firms like Johnson & Johnson, J&J, with consistent revenue. Utilities and infrastructure, companies like NextEra Energy, NEE, that pay stable dividends. Dividend ETFs, funds like Vanguard Dividend Appreciation ETF, VIG, can provide built-in diversification. Step 3. Reinvest dividends until retirement. While you're still working, let dividends compound by reinvesting them. This dramatically increases your share count and future income. Even if you're 5 to 10 years from retirement, this can make a significant difference. Step 4. Transition to collecting dividends. Once your portfolio generates enough passive income, you can start living off dividends while keeping your principal intact. If done correctly, your dividend income will continue to grow even after you stop reinvesting. Step 5. Plan for taxes. Dividends are taxed differently based on your income. Qualified dividends are taxed at lower rates, 0%, 15%, or 20%, while ordinary dividends are taxed as regular income. Investing in tax-advantaged accounts like Roth IRAs can help minimize taxes. Final thoughts. Retire like Buffett. Most retirees rely on savings and market growth. Buffett, on the other hand, lets dividends pay for his lifestyle without ever selling his stocks. This strategy provides a steady, growing income stream, protection against market downturns, a portfolio that keeps growing even in retirement. By following this approach, you can create a retirement plan that generates passive income for life, just like Buffett does. If you enjoyed the video, don't forget to subscribe to the channel. Click on the video appearing on your screen now and find out everything you need to know about retirement planning.